September 15th, 2008. It was supposed to be an ordinary Monday. People woke up, brewed their morning coffee, commuted to work. No one knew the global economy was about to change forever. But by the end of that day, the global financial system suffered its most devastating collapse ever recorded. Lehman Brothers fell after 158 years, triggering shockwaves that froze markets and terrified governments worldwide instantly. The fall of one bank shattered the illusion of stability everywhere. Employees leaving with cardboard boxes symbolized far more than lost jobs. It marked the failure of an entire economic structure.
Trillions of dollars evaporated within days. Millions faced losing homes, and credit markets collapsed under overwhelming fear and distrust.
And just like that, the system cracked open. But this crisis didn't suddenly appear. It began years earlier with a dangerous combination of cheap money and unchecked optimism. The American dream of homeownership exploded into a frenzy, fueled by low interest rates and aggressive lending campaigns nationwide. Home prices soared dramatically for nearly a decade, convincing millions that real estate could never fall in value. Greed wore the mask of opportunity. After the dot-com crash, the Federal Reserve pushed interest rates to 1%, unleashing historic borrowing incentives across America. Cheap money encouraged families, investors, and banks to expand loans far faster than incomes or economic fundamentals realistically supported. Banks eventually ran out of safe borrowers, and instead of stopping, they lowered lending standards to reckless extremes. Caution disappeared. Risk became the new normal. Subprime mortgages targeted people with unstable incomes and poor credit, hiding severe risks under deceptively low introductory rates. Teaser rates doubled or tripled after 2 years, trapping countless families in debt they could never realistically afford.
Look at this clause right here. The rate balloons after 2 years.
But the broker assured me the introductory rate was sustainable. This is predatory.
Then appeared ninja loans. No income, no job, no assets. Approved anyway through intentionally negligent lending practices nationwide. Banks didn't care about repayment because they were preparing enormous securitization pipelines designed to offload risk instantly. They bundled thousands of risky mortgages into large mortgage-backed securities, sold globally to investors seeking high returns. Rating agencies stamped these securities AAA, despite their toxic contents, because banks paying fees influenced the entire process. This conflict of interest created the illusion of safety and spread dangerous financial products across international markets unnoticed. Wall Street advanced even further, creating CDOs that repackaged failing loans into supposedly safer financial structures investors trusted. Synthetic CDOs allowed huge bets on mortgage failures without owning loans, turning markets into high-stakes financial casinos. By 2008, credit default swaps reached $58 trillion, dwarfing the real global economic capacity entirely. Lehman Brothers operated with leverage exceeding 30-to-1, meaning even tiny losses could completely destroy their balance sheet. Interest rates rose in 2006, causing adjustable mortgages to reset and monthly payments to skyrocket unbearably. Families began defaulting rapidly, first in thousands, then millions, triggering nationwide panic and collapsing housing prices dramatically. Homes became worth far less than mortgage balances, and borrowers sent keys back to banks in despair. New Century Financial collapsed in 2007, signaling deep cracks within the subprime lending foundation already deteriorating. Hedge funds tied to Bear Stearns imploded soon after, amplifying fear and eroding confidence in interconnected financial institutions.
What's happening? BNP just froze the funds. We can't access anything.
This is spreading globally. We have to warn the international desks now.
By late 2007, banks stopped trusting each other entirely, causing interbank lending to decline to catastrophic levels. 2008 became the year global finance broke apart, revealing vulnerabilities hidden beneath years of manufactured optimism. Bear Stearns collapsed in March and was sold to JP Morgan for almost nothing despite decades of prestige. Indimax suffered a massive bank run, collapsing under withdrawals and becoming one of America's worst financial failures. September arrived, bringing the most destructive month modern markets had ever witnessed, reshaping global finance permanently afterwards. Fannie Mae and Freddie Mac, supporting half of U.S. mortgages, were seized by the government to prevent systemic collapse. Then came the final shock. Lehman Brothers declared bankruptcy, unleashing chaos instantly across every global market simultaneously. Treasury Secretary Paulson refused a bailout, arguing moral hazard. But the decision triggered a historic global panic. Credit markets froze completely, businesses couldn't pay workers, and global trade slowed as trust disappeared instantly everywhere. AIG nearly collapsed under $400 billion in obligations from credit default swaps it never properly collateralized earlier. The government injected $85 billion to save AIG, preventing unimaginable international financial destruction instantly. Washington Mutual collapsed shortly after, becoming the largest bank failure in U.S. history with massive asset losses. By October, the Dow dropped 18% in a week, marking unprecedented investor panic and catastrophic market volatility.
I can't believe it.
We've lost everything.
Money market funds broke the buck, triggering mass withdrawals that threatened everyday financial stability across the country. Congress passed the $700 billion TARP rescue package, stabilizing banks but igniting fierce political backlash nationwide.
Bailout equals betrayal. Where's my rescue? Bailout equals betrayal. Where's my rescue?
Central banks coordinated emergency rate cuts worldwide, attempting to prevent complete financial paralysis and global economic collapse. The Federal Reserve launched quantitative easing, printing trillions to purchase toxic assets and restore market liquidity. Despite interventions, the human consequences were devastating, reshaping lives, communities, and political landscapes for generations. 8 million Americans lost their jobs, and unemployment soared to the highest levels seen in decades. More than 6 million families lost their homes, scattering communities and deepening long-term economic trauma nationwide. $11 trillion in household wealth vanished, wiping out retirements, savings, and decades of financial security permanently. Global unemployment soared as 50 million workers lost jobs across continents, worsening poverty and social instability everywhere. Inequality widened as wealthy investors recovered quickly, while ordinary families struggled for years without meaningful support. Entire neighborhoods collapsed, economically stores closed, factories shuttered, and foreclosures left communities hollowed and broken. The crisis sparked political movements like the Tea Party, Occupy Wall Street, and rising global populism worldwide. Bitcoin was born from the crisis, promoting decentralization after trust in financial institutions collapsed dramatically. Governments created sweeping reforms, including Dodd-Frank, imposing stress tests and restricting risky proprietary trading. Basel III strengthened global capital requirements to reduce systemic fragility and prevent high-leverage behavior. The Consumer Financial Protection Bureau formed to defend borrowers against predatory lending and widespread banking misconduct. But deep structural questions remain unanswered, leaving uncertainty about whether the system is truly safer today. Global debt levels exceed 2008, raising concerns the next crisis might be even more destructive. Derivatives remain enormous, with notional values reaching hundreds of trillions, hiding risks beneath complex financial layers. Housing prices again reached record highs, echoing bubbles that previously ended in widespread collapse and severe recession. Shadow banking grew dramatically, operating outside oversight and repeating patterns that destabilized markets before 2008. The same ingredients: cheap money, excessive leverage, hidden risk are accumulating silently in today's financial environment. History shows collapses always follow confidence, optimism, fragility, and a sudden shock that triggers cascading failure. The 2008 crisis exposed how fragile financial systems truly are when trust vanishes suddenly. When trust collapses, markets freeze, institutions fail, and societies fracture under the weight of uncertainty. Its aftershocks influence modern politics, inequality, technology, and investment behavior across every global economy today. The lesson is simple: ignoring risk makes collapse inevitable, and delay only magnifies the eventual destruction. If this history is forgotten, the world will repeat it, potentially facing an even more catastrophic crisis. The question remains: did we repair the system, or merely postpone the next devastating collapse waiting ahead quietly? This was the story of the 2008 financial crisis, the collapse that reshaped economies and societies permanently. Crashes do not unfold slowly. They strike suddenly and violently when least expected, changing history instantly. The 2008 crisis was not just a financial collapse, it was a warning. The question is not if it can happen again, but when.